Coleman, thanks for coming back and joining me again to continue our conversation about investing in a complicated world.
Thank you, John. Always good to be back here with you.
Last time we talked a little bit about hedging. Tell me how you use hedging and what some of your foundational principles are involving hedging.
Hedging is an essential part in today's environment. Again, we're trying to protect gains that we have already earned when the market wants to take them away. Let's focus for a moment just on hedging in the credit world. Many people skip over what we think is one of the most foundational elements of effective hedging, and that is every asset you buy, ensure that you're buying it with a significant margin of safety so you can absorb things that go wrong. Second, in an uncertain world and in a world where some of the investing actors on the stage are acting imprudently, we want to be further up the capital structure, holding senior assets and senior secured assets rather than more junior or equity-like assets. Then there are specific risk factors to consider. In credit, we're dealing with a contract for a certain amount to be repaid on a certain date. If the underwriting is good, then we're typically not concerned about the credit risk, but more broadly concerned about other general changes that might take place in the markets that adversely affect the price of our credit. Certainly, we would be concerned about higher inflation that might be impounded in higher interest rates. Hedging against that currently would include keeping the portfolio duration short, 3 or 4 years in the average instrument life rather than 10 or 30. It involves more than half of our portfolios being held in floating rate instruments so that if rates in fact do rise, then the rates that we're earning on those instruments will rise with them. And then from time to time, the market offers a risk-return proposition where you can use gold or direct interest rate hedges in a combination that's attractive to us. We also want to protect against anything that would result in a reduction in the value of all credit. For example, a shock in the Eurozone as they try to work out their solvency problems there. Using credit default swaps against certain of the European nations is one way to do that. And again, there are circumstances where if you think of gold as a hedge against those shocks or interest rate hedges against those shocks, certain circumstances where they can be added to that. And then finally, we want to ensure against a sharp decline in the broad equity indices, and typically that might involve selling out of the money puts against the S&P 500. Piecing all of those elements together gives us the overall mosaic that we're looking for to protect against downside loss.
Do you use hedging across the board?
Not in every circumstance. In capital expansion strategies where the objective is capital growth and we're taking more risk, we tend not to use hedging. But these are capital preservation strategies, certainly everything we're doing in the credit and the absolute return worlds. In those circumstances, we want to apply hedges to protect gains where we can. But hedging can be very expensive if it's poorly conceived or if it's poorly executed. It makes sense to remember this simple dictum: caution, do not attempt this at home alone.